In this video, we're going to talk about what it means to go short a call option and how much money you're going to make from it. So if remember back to think what a call option is, it's the right to purchase a stock in the future. So one person has the call option, is long it, and the other person is on the other side of the table is short the call option. So this diagram here that I'm showing you is the perspective from the person who's short the call option. He's going to make an amount called a premium, and that premium is the cost of purchasing the call option, and that amount could be whatever amount really. It's quite fixed in reality using the Black-Scholes model and a bunch of other things, but for the purpose of this example, we'll just stick in a number and we'll show you how the profit works out from there. So if we have a premium, and let's say that's a premium of $2. So that means if the call option isn't exercised, the person selling the stock is going to make $2. So right off the bat, we're looking at a $2 premium. So from the perspective of the person long, he has to purchase the premium, he has to pay it, and the person who's short the call is going to receive the premium. Now if the price of the stock goes up, then the call will be exercised, right? If the price of the stock goes down, it's not going to be exercised. Let's think about that, just to drill it in your brain a bit. So we have another payoff diagram. If the price of the stock goes up, then you have the right to buy it. You're going to buy something for a cheaper price than what it's worth. You're going to pay the exercise price, this amount, and you're going to receive a stock worth this amount. You're going to make the difference there. If you don't quite get that, then go back and review the other video. But it should make some intuitive sense at this point. You're going to make money if the stock goes up. So he's going to receive, he's going to pay the exercise price. He's going to pay the exercise price. Let's say that's X is equal to 10. And he's going to receive some stock amount, which has to be greater than 10, or it's not going to work. Now, if that's exactly 12, then obviously this is going to be worth 0. If it's less than 12, then this person's going to, well, I'll show you now. If the stock is the value of 12, then the person has paid an exercise price of $10. He's receiving a stock worth $11. But there's a premium that he paid earlier on. So he works it to a net of -$1. So in other words, the person on the other perspective is going to receive a premium, and if the call option is exercised, that means he's going to receive the exercise price, and he's going to have to pay out the stock. Now that stock could be whatever, who knows what that amount is. If it's going, it could be 11, could be 12. It's going to be the same amount for both parties though. So in this case, it's going to be 11. So in our example here that we've looked at, the person who's long the call option is going to exercise it. He's going to make money if the premium is less than this difference, and he's going to lose money if the premium is more than this difference. So you can see here, looking at this diagram, there's a few things that we should note as well about this. Make sure you understand this quite well, because this is pretty much the really straightforward, simple idea of a call option. It's the idea that you make money if, depending on the premium, whether it's high, whether it's low, and how much does the stock go up, and which side you're looking at. So there's a few things that you need to consider. You just have to identify whether you're the long person or the short person, and then you just have to work out each one of these steps. How much am I paying? how much is the exercise price, how much is the price of the stock, and then you can figure out the amount of profit you're looking at. So looking here, we can see a few implications. First of all, you can lose a lot of money if you're short a call option. There's unlimited risk because the stock price can just keep going up. It could go all the way up. It doesn't have to end. You could, if the stock was $10 in our example and it went up to $100, all of a sudden you're looking at a $90 of lost profit there. On the other hand, you're capping the amount of money that you can make from this transaction when you short a call, because you can only make the most amount as the premium. The most money you can make is if the call option doesn't get exercised. So you need to be pretty darn sure that the stock is not going to go up if you're going to go short a call option. So that's what it is at the end of the day. You just have to kind of battle it out, figure it out whether the premium is high or whether it's low, and the amount of profit is just going to be depending on, first of all, is the exercise price going to be exercised at all? If so, it's going to be exercised. Then you have to do the rest of the transaction and figure out how much is the difference between them. So hopefully that makes some sense to you. And if you don't quite understand what a call option is, once again, go and review the other video. It'll make a little more sense, and then come back and watch this again, and it should all sink in. Hopefully that was helpful, and we'll see you next time.